I think it's almost daily now. I see a headline that solar is setting a new record in various markets. So it's that time of year. We've installed more solar over the previous 12 months. We're hitting the sunniest parts of the year. And so whether it's here in Europe or parts of the States, China, on down the line, we keep seeing records being set.
It looks like we're going to add about 20% more solar this year than we did last year, for a total of 700 gigawatts this year. Like always, more than half of that's going to be in China, but in Europe and in the US, they're each going to cross about 50 gigawatts.
Demand throughout the continent has gone up, and that has been met in part by higher gas-fired generation. Despite all the additions that Alessio was mentioning, it seems like we're reaching that sort of optimal threshold, and that perhaps signals that we're missing more transmission capacity, or perhaps battery storage to sort of level out or incorporate those intermittent renewables.
And then, of course, we still think renewables will take a part of the demand growth. And like Patricia was saying, in some European countries, it seems like we're kind of reaching an optimal level of how much we can push on the renewable side, but there's also batteries and there's still project additions that can be done and that are being done by utilities. And that will also be an important part of the mix.
I think in June, geopolitics was the important driver. We were talking a lot about geopolitics, and that was driving oil prices. I think now the shift is very much shifting away from geopolitics. I think the geopolitical risk premium has pretty much gone away for oil prices, and now we are focusing on fundamentals. I mean, we've been saying this for the last couple of weeks, but I think the market is also starting to focus a little bit more on the fundamentals.
Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we are live from Madrid with the team here. So we've got a number of regulars. We've got Patricio Alvarez and João Martins, who are based here with the cool lit up Bloomberg signs over their heads. And then we've got Sally Ilmaz and Alessio Mastrandria. Sally's from the Dubai office typically, and Alessio sits in London. So that's the crew for today. And we're going to talk about some of the interesting things that we've been putting out lately. And also, I think we'll touch on some of the topics we've been discussing with clients as we've been doing a little mini roadshow around Europe here this past week. So I think one thing that I'll start with, and Alessio, we're going to come to you first, is just, I think it's almost daily now. I see a headline that solar is setting a new record in various markets. So it's that time of year. We've installed more solar over the previous 12 months. We're hitting the sunniest parts of the year. And so whether it's here in Europe or parts of the States, China, on down the line, we keep seeing records being set. Can you frame that for us and tell us how that feeds into our current thesis on solar?
Yeah, sure. So thanks, Rob. Now that we're about halfway through the year, it's good to talk about where we're going to be in 2025. And it looks like we're going to add about 20% more solar this year than we did last year, for a total of 700 gigawatts this year. Like always, more than half of that's going to be in China, but in Europe and in the US, they're each going to cross about 50 gigawatts. Just to give you context of what 50 gigawatts means, that's close to what the capacity of the UK grid is. It's been very, very sunny in London and Spain. Just over the past week, solar has made up about 14% of the UK's grid capacity, 26 just today. But over the past year, it's been much smaller. So it's only been about 6.3%. So we're seeing solar everywhere now that it's summertime, sun shines out. And we could just see that number creep up consistently, despite the ongoing narrative with the One Big Beautiful Bill in the US and what that means for the future of build out and demand.
Now, since you mentioned that most of the capacity additions are in China, I mean, it's a staggering number, something like 80% this year so far. Like China is the real juggernaut in this space. And a lot of the supply chains there, they've been having essentially a little bit of a death match, competing prices down for modules. We're about 9 cents a watt these days versus you only have to go back a couple years and you were closer to the 30 cents a watt. So given all of that excess capacity in China, how would you frame this question of, is solar even investable? I know we tend to look at more of the Western names anyhow, but give us a sense, what has that excess capacity done to some of the equities?
Yeah, question we get from clients a lot is solar becoming a commodity? You could say it is. That 9 cents a watt has been kind of the bottom that we've seen, and I don't know if we'll see it go that much lower in the near term. A couple weeks ago, I saw an article saying that a lot of Chinese factories are going to lower production in order to bring the price of solar back up, because in China they're just cannibalizing margins. We like to talk about First Solar a lot and their 40% gross margin. They're able to achieve that partly due to subsidies, about half that's due to subsidies, but the other half is just that the pricing of solar in the US is still at 30 gigawatts, 30 cents a watt. So I think we might see a bit of a paradigm shift where the global price does go up, but maybe the price in the West does creep down a little bit. But other than that, what is it doing? There's a lot of modules from China in the ports of Europe just waiting to be deployed. So it makes it difficult for Europe to have a global champion. One of the companies I cover is Meyer Burger. They have struggled historically to be competitive, so they moved their production to the US and back, and now they're in a bit of a bankruptcy battle. But yeah, cheap Chinese solar is good for the grid, but maybe bad for manufacturing.
All right, thanks a lot, Alessio. Patricio, let's get your perspective on this topic. Is your general sense that, are you seeing this summer the increase in renewables over the past 12 months? Is it eating into the gas demand narrative, particularly in the power sector? Is it other factors? Just looking at the screen right now, and it looks like TTF's roughly 35 euros a megawatt hour. I feel like it's been kind of hovering at that price for a while every time we have one of these conversations, maybe spiked a little bit after some of the Middle East conflict. But yeah, give us a sense of, how renewables are feeding into the supply stack here.
Sure, Rob. So I think it's important to note that gas demand is highly seasonal. So if you were only to see what happened in the first quarter of this year versus 2024, what we saw is that in 2024 we had ample renewable supply. So that's not only incremental capacity additions from wind and solar, but we had record reservoir levels and also very high or relatively high nuclear output in the first quarter of 2024, and that was that was met with very lackluster demand for power back then because we had a very mild winter season. So prices really collapsed in the first quarter of 2024. And if we move forward to 2025, this last year we've seen a stabilization of power prices. But again, the caveat is gas is still driving power prices pretty much. So on the middle of February, we saw a spike in gas prices. They went up almost beyond 50 euros per megawatt hour in February, and that was driven by a cold spell. So we had a significantly colder winter season. Our storage levels are lower. So if anything, gas prices are still driving power prices. And if you look at the stack, yes, solar and wind, well, mainly solar, continues to carve out, I would say, the share of supply from gas in the power stack, but we're still pretty much reliant on gas. So the share of gas is still hovering close to 20%, and it's become sort of stubborn. It doesn't matter how much more capacity we continue to add. I think it shows that we still need to fire up gas because we continue to decommission coal plants. Nuclear capacity is flat to declining. So whenever we have peak demand or higher heating demand in this case, which is what's been going on since the second quarter, is because cooling demand throughout the continent has gone up. And that has been met in part by higher gas fire generation. Despite all the additions that Alessio was mentioning, it seems like we're reaching that sort of optimal threshold, and that perhaps signals that we're missing more transmission capacity or perhaps battery storage to sort of level out or incorporate those intermittent renewables.
It is fascinating because in the States right now, there's actually a little bit of a mini resurgence in coal happening this year. So you've seen coal gen tick up a little bit. Plus, you've had renewables come up, and I think the sort of theory is that sort of gas takes a little bit in the power gen side. There's probably a seasonal component to it. I got two more follow-up questions though for you, Patricio. So one is, how many markets here in Europe? I mean, I appreciate your idea that sort of gas is generally the marginal source. It's set in the power price, but I think in a number of markets, like during the middle of the day, you're seeing like low prices, negative prices because of so much solar. Can you give us a sense of like, how many markets are we seeing that in right now? How much runway does solar have? Because is this basic idea would be that as you add more solar to the grid, you get so much of it at one given point that you push the power prices so low when they're all on in the middle of the day that you effectively don't need anymore. Where are we seeing that phenomena play out?
So that is happening all over the continent. I don't have an absolute number of countries, but it is an occurrence that has been repeated throughout the country. So you're talking about throughout the continent. So you're talking about even countries like Germany, which has a relatively higher share of gas-fired power than places like Portugal and Spain. Germany already saw a record number of negative pricing days this year again, on a consecutive basis versus 2024. So you continue to see these increasing instances of negative prices, which is it's a big threat mostly for generators that are upstream generators that don't have a retail portfolio, so that are selling into the grid. That are merchant sellers that are not hedged or supported by a long-term contract or some sort of subsidies. These companies are seeing their realized prices collapse, and I think it's important to note because we do get this question often: is how do negative prices impact the larger utilities? And the truth is that it mainly, it does affect them, but not as much. You can think about it as an integrated utility like an Iberdrola or an Naturgy or an Engie. They have a very diversified power stack. So when prices go negative, what they will do is just sort of write off that power. They'll curtail it and just use other sources to meet that demand. They either fire up gas or coal in the few companies that still have coal here in Europe. So that's kind of the dynamic. But I think the problem from this occurrence is that it sort of murks or dims the investment case for solar, especially because it means that it's sort of a race to the bottom in terms of costs because investors are more skeptical in investing in a long-term project when they continue to see wholesale power prices declining.
All right, thank you, Patricio. So just a quick data question follow-up, and thanks for folks who are talking in the chat right now. And we'll drop some links in. But Patricio, just generally given talk about demand and that sort of thing, what's the best way for clients to find this kind of information on the terminal? I'm thinking perhaps the INSOE data, but there's probably others. So if you want to give a quick rundown of just how you could quickly get to that, I think that would be useful. And again, we'll also drop a link into the chat.
Sure. Well, this is a bit of a commercial slot for us. Then you can find all this information at BI Go, particularly in our electricity European Electric Utilities Dashboard, which is BI EGNE. Of course, we'll drop in the links. You can find most of the information for European power. Power supply and demand and the different sources in our dashboards. We also published a deep dive last year where we, as the name says, we went deeper into how much upside there is for incremental power demand stemming from the rollout of data centers. That's both that is mainly focused in the US, but we also have a significant European chapter. So yeah, I encourage people to check it out, and we're always here to answer your questions.
Fantastic. There's an analog for North America on this, which Zhao has kindly dropped into the chat as well. So check both of those out. I would also flag that we've just ingested a bunch of data on the wind and solar side. If on our solar dashboard, that will also drop in. I'm just kind of seeing what's happening there and some of the records that Alessio was talking about earlier. Zhao, I'm going to come to you next with actually one of the questions in the chat, because I think it's interesting and I know you're going to have some perspective on it. So where is electricity supply going to come from with natural gas turbines sold out for 5+ years at the OEMs? And our general sense on that is, this aligns with everything we're hearing. If you want a new combined cycle gas turbine from GE, Vernova, or any of the other suppliers, you kind of got to get in line for quite some time. That being said, I would assume that a lot of folks do have orders on the books already, but give us your read, Zhao. What's going on with turbines here in Europe, and what's the supply stack going to look like in 2 or 3 years' times versus now?
Yeah, sure. So like you said, we think, just broadly at first, we think most of the demand needs to be met with renewables, gas, and in the US, some of these nuclear reopenings. So we think if the gains from AI and all the prospects are going to materialize, we're going to need every type of electricity that we can get. On the gas side of things, and maybe looking a bit more into Europe, gas might not grow as much as in the US. It will depend on the country. For example, Germany is aiming to build 20 gigawatts of gas-fired plants. That's been delayed for a couple of years. They're now aiming to tender some of that this year to start building over until 2030. But like you said, and like our clients were mentioning, there is a wait list for of 2 to 5 years, I think, for gas turbines. But I will say that just from the comments that our utilities have made, a lot of them have already pre-procured the parts that they need to build those new plants. For example, RWE and Uniper have made comments along these lines. So although there is that their wait list, I think there might be for some of these utilities aiming to build new plants, it might not be as bad as it looks. And then of course we still think renewables will take a part of the demand growth. And like Patricia was saying, in some European countries it seems like we're kind of reaching an optimal level of how much we can push on the renewable side, but there's also batteries and there's still project additions that can be done and that are being done by utilities. And that will also be an important part of the mix.
All right, fantastic. There's a couple of questions in the chat, renewables related, which we will swing back around on in a few minutes. But first, I want to get Solly into the conversation. Just checking the screen here at the moment. Brent's a little below 68 a barrel. There's some news out of OPEC, I think, since we last spoke. So give us a sense of what's going on with oil macro here at the moment, Solly.
Sure, thanks, Rob. So, we've been on the road this week, so I actually had to spend the last 10 minutes or so trying to catch up on what's going on in the oil markets, because every day there's something, many drivers for the oil prices and many moving parts for the oil markets. But it seems like, the last few days, oil is down slightly, and I think, and this is what we've been talking to our clients about in the last few days, is I think in June, geopolitics was the important driver. We were talking a lot about geopolitics, and that was driving oil prices. I think now the shift is very much shifting away from geopolitics. I think the geopolitical risk premium has pretty much gone away for oil prices, and now we are focusing on fundamentals. I mean, we've been saying this for the last couple of weeks, but I think the market is also starting to focus a little bit more on the fundamentals. And when we look at the fundamentals, it is true that the prompt market, so the physical market for the next couple of months is still looking pretty tight, which actually makes what OPEC Plus was saying about strong summer demand probably accurate, in the way that one of the reasons they gave for increasing output through summer was that there will be better summer demand. And when we look at the northern hemisphere, it's the driving season. Usually seasonally demand is better, and it's actually been quite hot. I mean, it always is in the summer, but it's been hotter than usual in the Middle East as well, which means a lot more consumption from air conditioning. So in the next couple of months, in the prompt market, market is looking pretty tight. But when we look beyond the summer and towards the end of the year, the fundamental picture that we've been arguing is actually looking a lot looser. And that's because a lot of these hikes that OPEC Plus has announced will start taking effect. And at the same time, I mean, I think demand hasn't been so bad, but we just see the marginal supply growth surpassing marginal demand growth by quite a margin towards the end of the year, especially in the fourth quarter. So we see significantly oversupplied market unless something changes, unless there is a big supply disruption, of course. But when we look at that, it is no surprise that perhaps the price risk in the oil market is tilted to the downside from here. But again, what we've been talking to our clients in the last few days is that our base case scenario remains $65 to $70 a barrel, perhaps towards the end of the year. If what we're thinking in our balances materializes, I think we can move towards $60 a barrel, given the loosening fundamentals. And the bullish case that we talked about a lot more often last month on geopolitics, that seems to be an even lower probability as things eased in the Middle East. It's always a tail risk. It's a low probability, high impact scenario. It is something that we still have in our scenarios table, but what we're focused on a lot more right now is the base case scenario and the downside tilt on prices from here onwards.
Sally, just give us a quick preview as to how you're thinking about how that outlook feeds into the kind of narrative we're going to hear in 2Q earnings calls for your names. What's your sense? Sounds like that's more forward looking, but how did 2Q shape up, and what's 2H going to look like?
Yeah, I mean, perhaps I'll start with Saudi Aramco, which is, I think, the most relevant. Given Saudi Aramco being responsible for the totality of Saudi Arabia's oil production, Saudi Arabia being the de facto leader of OPEC Plus, so the OPEC Plus policy obviously directly impacts the company. So when we look at the second quarter, we know benchmark oil prices were down significantly by about, I think, 22% year over year in the second quarter, which, again, not only for Saudi Aramco, but across the space, that lower pricing is going to be a headwind for the 2Q results. But then, because OPEC Plus's new policy is increasing quota levels for other countries, and in the case of Saudi Arabia, that's a significant increase. And also, what was reported in the last week or so is that Saudi Arabia may have reached its quota in June by, according to the IEA, by 400,000 barrels per day, which is very, very rare. They denied it. We don't really have the final numbers yet, but regardless, I mean, we know that towards the end of the quarter, they will have a much higher output level, which will help kind of soften that hit from lower pricing. So when we look at Aramco, perhaps most relevant to the oil macro that we were talking about earlier, it's still their net income is still going to be lower, most probably year over year because of that lower pricing, but they're going to get a little bit of support from higher output. Another one that I thought was quite interesting and watching very closely is Repsol, the Spanish major here in Madrid. You know, what's interesting there is that, as you know, and as we discussed on this call a month ago, they had this blackout that went on for a couple of days, and we did argue immediately after that this could have an impact on Repsol's refining sector, and they did actually highlight in their trading update that that blackout did actually have an impact on their utilization, and one of that is going to be one of the drivers for a relatively soft downstream results, which is also being impacted by softer refining margins across the space, and perhaps just also across the whole peer group. Chemicals remain quite weak for all the companies that have exposure to chemicals. You know, we've been talking about this for a while now. It's a U-shaped recovery, it seems, in chemicals, but a very wide U, it seems, because it you know, the chemicals market remains the fundamentals in the chemicals market remain very, very loose and very much oversupplied. So we are not really seeing a significant uptick in margins in the chemical space either, and that's not only for Repsol, that's for other companies such as OMV as well.
All right, thank you so much, Sally. Before we hit the half-hour mark, we're going to run a little over, but I just want to do a quick advert. For anyone who's on the call, who's in Madrid, we hope to see you tomorrow. And for folks who are on the call, who we got to see in person in Copenhagen earlier this week and in London last week, it was great to see all of you in person. I do promise we're going to have some North America events in the fall. Definitely going to have Houston around mid-September. We'll get New York in the mix at some point too, very near future. And then I just want to hit a couple more questions from the chat, and we'll tie them into 2Q earnings. So let's see how this is going to be for you, but we've got two questions on the recent tax legislation in the U.S. So I want to get a sense, you know, how much of a headwind is this? And then I feel like it's a leading question because hopefully the individual has read some of our research on this, but, you know, how material do you expect the demand pull forward to be from the tax change legislation? And so for anyone who's unaware, you basically have a 12-month clock that if you start construction, you're able to receive full value of existing tax credits. So we've been making the argument that we're actually going to see some pull forward. But Alessio, if you could just tie that into kind of 2Q, what do you think the earnings discussion is going to be focused on for our names in this space?
Yeah, sure. So the theme for Q1 was tariffs, and we might see a little bit of that again, but the theme for 2Q is definitely going to be the one big beautiful bill. And if we want to get a sense of what the pull forward can be, we can use history as our guide. Enphase is the first company in our coverage to report, and they're particularly impacted by the one big beautiful bill because residential tax credits are going to sunset at the end of 2025. And a good analog for this could be Q1 2023, when California ended its net energy metering 2.0 program in favor of the 3.0 program. Just a little history, if you don't know what that is, in order to get tax credits for your excess solar, it shifted from just being rooftop solar to solar plus batteries. And we saw Enphase has its best ever quarter in the lead up to that sunset on, I think it was April 14, 2023. Now, I'm not saying that we're going to see sales double and get back to those record values, but we could definitely see sales surpass the 11% growth consensus has in 2025. We're going to see similar on the utility side, depending on how João Patricio's companies get started. But yeah, I imagine, at least in the short term, we're going to see a rush of new projects added.
Fantastic, Alessio. Okay, I want to come over to you, Patricio, and I want your read on this as the utilities guy. And I know you're a bit you're European focused, but a number of your names do have investments in the U.S. What do you make about the pull forward thesis? And also just go ahead and give us a quick 2Q preview as well.
Sure. So on the pull forward thesis, I think that the latest executive order from President Trump trying to make safe harboring more restricted. So safe harboring is that that securing of tax credits that means that you can basically just put down 5% of the total project cost over the next 12 months. As you said, to meet that window, if you just put in 5% of the capex, technically you could build those assets for the next 4 years, or throughout, or finish completion throughout the next 4 years. So it's really a 2030 deadline if you think about it that way. So I think on that, on that axis, if the restrictions are not enacted or don't come as fast as the executive order aims to do so, which I think is also part of our thesis, then perhaps, yeah, our European utilities will continue to build. If anything, all of their projects under construction are safe. So European utilities have roughly 48 gigawatts of renewables in the US. And they have about 13 gigawatts under construction. So that means that growth for the next two years is basically guaranteed in the U.S. Is not exposed to these changes in U.S. policy. But I guess we will have to see how that last executive order plays out in trying to change those safe harboring restrictions in order to see to see a bit more movement in trying to move some of that pipeline forward. So that said, I think capacity under construction is safe, but moving forward, yeah, I think the growth outlook in the U.S. has declined or has been curbed by this policy uncertainty. And on the second part, on mid-year outlooks and or previews, so far it was very early in the cycle for European utilities. We've only looked at Iberdrola and Centrica. So in terms of Iberdrola, I would say that's the flagship European utility. It is the largest in the index, and it's a company that has a diversified networks portfolio. So that means that the company is poised to deliver on that double-digit EPS growth this year, and that is mainly on the back of higher spending into grids in high credit quality jurisdiction like the US, the UK, and Spain. So we expect solid results from them. Nothing comes to our attention that risk that double-digit EPS growth. And I think the other utility perhaps that is worth mentioning, like I said, is Centrica. Centrica probably benefited from a fresh bout of UK gas volatility in this first half of the year. Like I said, prices spiked in February and again spiked in July, in mid-June as well. So we think that plus incremental demand, which tends to help retail gas margins, we think those make up for a strong set of results for Centrica, and that could also mean that the company could boost and extend their share buyback program. So that being said, Centrica doesn't pay a huge dividend relative to other utilities, but their buyback program looks pretty strong, and we think unless there's a meaningful change in policy, they could extend it into 2026.
Fantastic. Thank you so much, Patricio. Zhao, I'm going to come over to you. Give us a 2Q readout for the names in your space, please.
Yep, sure. So for pure renewable developers, and I mean, we're just starting to prepare for the earnings season, but we're expecting continued strong earnings growth this year, following Q1. That's largely driven by project additions last year, which reached the record both in the US and Europe, and is driving a lot of volume gains for these peers this year. Also, power prices, realized power prices stabilizing with hedges still remaining strong, inherited from 2022, 2023, and spot power prices now stabilizing. We think that might form a platform for these peers to deliver on earnings growth based on those volume gains. That's this year. Beyond, we expect growth to slow with we've in these calls mentioned many times the slowing investment outlook of these companies, and that will be reflected in slower earnings growth as well from 2026, 2027. So this year consensus for EPS growth is more than 30%, which we think is reasonable based on these reasons that I outlaid. From next year, that's going to come down to mid-single digits. And like I said, that's just reflective of the investment outlook. And so for this earnings season, we're just kind of looking for signs that those power prices remain resilient, and that volume gains are materializing.
Thank you so much, Al. So a couple more questions from the chat that I'm going to take the liberty and just hit those real quick. So one of them is, does OPEC attempt to manage supply to thwart influence capacity build for renewables? You know, Solly had to run to another meeting. I would have given that to him, but I think, you know, he would just mainly point out that I think, you know, OPEC is much more focused on the liquid fuel market, and there just really is very little oil that plays much of a role in the utility space outside of the Middle East region. And so I think that, you know, there is a sweet spot for oil, and I do think that the higher the oil price goes, the more you'd see, say, the proliferation of EVs and that sort of thing. And then that could be more of a way to kind of think about energy transition and how OPEC kind of thinks about their role in the market. And then just last question that's in the chat is just about AI data centers, because it's been a topic for our group of conversation here lately, and the sort of, you know, most cost-effective energy supply for AI data centers. Look, in the U.S., it's going to be a portfolio of gas, probably paired with battery storage and some renewables in the mix. I mean, all the hyperscalers do have pretty profound ESG commitments, and so even though gas might be the sort of firm electron that you've got there at the grid at your data center, you might still be contracting renewables because of broader sets of ambitions. And so I think, you know, if it was just pure economics, it would just be probably gas, but there's also other factors at play. So I think we're going to see other types of things being built to help support that build out. And I would also just point out, because this is something we regularly like to knock on, if you want to build something fast, you can build solar pretty fast. You can build battery storage pretty fast. You can build gas fast in theory, but there's a turbine backlog. And so we think solar plus storage is going to have some near-term demand read across from all the investment in data centers. So I think that's probably an interesting place to leave it. Happy to chat with any one of you offline. We normally hold these calls an hour earlier. We had to move it back due to some travel constraints this week. And then next week, we're actually taking a break. So we will resume week after next, and look forward to talking to everyone then. Take care, everyone. Hope you have a great afternoon or evening, depending on where you're at. Cheers. Bye.